September has traditionally been a weak month historically for the Philippine markets. With the looming economic slowdown, let's discuss some strategies moving forward. My name is Den Slim, and welcome to another episode of Monday Market Outlook. As expected, the disappointing miss on the Philippine GDP growth rate of 4.3% has spurred a slew of downgrades from analysts. So, Pantheon Macroeconomics has adjusted the full-year growth projections to only 4.5% from 7.6%. They describe the 4.3% second quarter slowdown as a disaster. Adding to that, Global Source Partners has nudged down their forecast to 5.2% from 5.5%, citing an expected slowdown in consumption as pent-up demand eased and inflation is starting to erode our purchasing power. They also mentioned the same concern that we brought up in our previous episode, where government spending underperformance was a big surprise. If we go back to the Quarter 2 GDP breakdown, it showed a massive slowdown on government spending, even contracting by 7%. Minus government stimulus, how will the Philippine consumer or the Philippine economy perform in the coming months? Inflation will also be a concern moving forward, as the Philippines is highly susceptible to inflationary pressures. Remember that food and beverages comprise almost 39% of inflation, of which 9% is from rice. With rice prices at its highest and with a looming price shortage, things are really not looking good for the Philippines. Now, the Philippines ranks second behind Singapore in terms of our susceptibility to supply-side inflationary shocks. A quick look at oil is also alarming, as we see oil prices to year-to-date highs settling at 85.98. It settled at 79 support, even below 79 support, before rallying back to new highs. And where's the next resistance level here? 92, 93. And if we look at the inflation projections, we can see a small uptick here in August, followed by supposedly improving numbers until the end of the year. But we would most likely have an adjustment on this downtrend based on rising oil prices. But our outlook for the end of the year, taking into consideration lag effects of rising supply side shocks, we could be headed towards 5.5% by July of next year. But with all the negative sentiments pushing the markets down, valuations are actually quite attractive right now. Our current PE ratio is at 12.4, which is cheap, compared to the historical average of 19. If we look at the forward PE ratios, we actually have one of the lowest forward PE ratios in Asia, but disappointingly, we are the fourth weakest performing market. But this could actually be a good buying opportunity for investors. Now, looking at the market EPS, earnings have actually been steadily improving for the last 3 years. And if we look at the adjusted earnings per share based on recent earnings reports, these are the companies with the highest percentage change compared to the consensus forecast. Now, we have Cebu Pacific, MREIT, Bloomberry, Meralco, and JGS with double-digit EPS change percentage gains. But traditionally, if we look at the historical data, September is the weakest month in the PSEI. And if you thought August was bad, we actually have historically weaker months ahead of us, with September being the worst. In the past 30 years, September has usually been brutal, with an average of a 70 basis points drawback, a 0.7% drawback, followed by December with only a 0.04% gain. August is actually just the third weakest month, followed by February. Let's look at the PSEI charts. We finally had a positive week after a 4-week losing streak, with the index settling down at 6,181. Now, if we look at the 2-hour charts, we can see the price action tracking quite well along the downwards price channel. Though we do have to take into consideration a number of rebalancing that happened last week. Now, going back to the daily charts, the big red candle here is most likely rebalancing related. Now, taking out the price channel here, we could see how the 6,150 support level has held so far. and we could be seeing a basing pattern happening along this level. Now, if we do experience a downward move for September and we break down from the 6150 support, we could be headed towards 6,000 or 5,850. So again, this could present some interesting areas to buy into our favorite stocks. Now, with the threat of an economic slowdown, investors usually rotate into some defensive positions. And what this basically means is an increased allocation on your portfolio for stocks that are less susceptible to a slowdown in the economy. These are usually your utilities, your commodities, or your high-yield dividend stocks. Let's look into some of my picks for high dividend stocks. Of course, the top of the list is SCC with an 11% gain all the way to BPI. Now, of course, there are stocks that would probably give higher dividend yields than the ones listed here. But we have to filter that list, taking into consideration company fundamentals as well as the potential for the companies to increase their dividend yields moving forward. Now, let's look at some charts for these stocks. We have SCC. As mentioned, the consolidation here at 27 to 29 would be a good time to accumulate SCC before the expected dividend announcement by October, right? So, this pullback here could present a good buying opportunity. Now, PLDT, on the other hand, although it gives a 9% dividend yield, you have to look at the price action here. PLDT has been going down for, 2 years now? And from its 48 billion overrun issue here, which brought the price down to 1,200, it's now back at the same levels and has even broken down at that level. Now, if you go back to our episode during that time, I mentioned that there's something fundamentally flawed with PLDT for them to incur such an overrun. And for me, we can only start looking at PLDT when it hits 1,000 or below. And based on the price action last week, this could be a possibility in the near future. But as of the moment, it's giving a 9% yield. If you buy now, could it go down to 1,000? If it goes down to 1,000, the loss would actually be bigger than the yield. So this is something that you also have to take into consideration. Now, CREIT, of course, we mentioned last week, 251 is my buy point. The dividend X date is on September 8. So expect a drawdown in prices as what usually happens after the dividend X date. And again, this could be a good opportunity to buy into CREIT. DMC also, the price is already going up in anticipation of an October announcement. So this is a good time to accumulate. RCR is at an interesting zone. It went down to its support level at 485 and bounced off strongly from that. Now note that RCR had a big drawdown due to its deletion from the MSCI index. This could actually be a good opportunity to buy into RCR given that it's probably giving something around 7.6% dividend yield. MREIT also, good earnings report, but it broke down of its support level here at 1378. 13 pesos could be 13 pesos, 13.50 could actually be a good entry point considering that it's giving around 6.5% yield. No? LTG also, a good entry point would be 880, but its recent X date at September 1 means that you have to wait until December. No? So this drawdown here could be a good opportunity to start accumulating for the expected December dividends. A-REIT, of course, we mentioned anytime it touches 32 is a buy for me. At its current level, it's giving around 6.3 dividend yield. Metrobank, 52 would be your entry price. AP, as mentioned, a confluence of support here at 34.25 and it has recently gone up. So AP will declare dividends by March next year. So this could be a good time to start accumulating it given that it is at a critical support level where you could get a good price for AP. DNL, not looking so good so far, but is at an interesting level that we identified last week. We've set an alert at 663 and it's currently at 669, and DNL could be forming a basing pattern here. Now, if you look at history, this has been a very strong support level for DNL. So it might be a good time to buy here. Of course, BPI. BPI is giving a 3% yield. Not that big, but look at the performance of BPI so far this year. In June, we identified a swing trade opportunity based on this confluence of support, a horizontal line support and a trend line support here. Our entry was 102 and our take profit zone was supposed to be at 117, but it even went higher than that. Now we are at the same situation here where it is at a confluence of support here, horizontal support line as well as a trend line support. So a good entry could be at around 109. A stop loss could be drawn here, right, which would present a risk of around 4%. If we look at the potential rewards here, assuming it will reach the same level, 120, that's a 10% reward. So not bad. But if we draw a Fibonacci support level here, assuming it bounces off, right, our next profit zone could actually be at 123 here, which would give you a good 1:3 risk-reward ratio. So those are my top dividend stock picks. Do consider adding some defensive stocks into your portfolio to hedge against a possible economic slowdown. Now, on to the global markets. It was a busy week in the US markets with a number of important data, economic data coming in. We have the consumer confidence, employment numbers, and GDP numbers coming in mostly worse than expected. But nowadays, bad news is good news. We have lower consumer confidence, lower job openings, GDP growth compared to forecast is lower, PCE in line with expectations, non-farm payrolls a bit higher than expected, but unemployment rate coming in at 3.8, significantly higher than the 3.5% expectations. Now, this is the first sign of a slowdown in the economy. Now, could this be the end to Fed rate hikes? Taking a look at the Fed Watch tool, the September 20 Fed meeting is almost a guaranteed rate pause at 94%, which is actually up from 80% of last week. Now, interestingly, the target rate probabilities for November 1 has shifted from a majority sentiment of a further rate hike into a rate pause at 64.6%. That's significantly up from 44.5% from just a week ago. And if we look at the December rate probabilities, it's the same scenario. The probability of a rate pause is now at almost 62%, which is again up from 44.5%, with even a 5.6 probability of a rate cut. But realistically, while we might be at a level that Chairman Bostic has termed as sufficiently restrictive, we have to accept that rates will continue to hold at these levels for a longer period of time because the Fed is trying to avoid what happened previously during the 70s. Now, if we look at this chart where the Fed cut rates too soon, there was a rebound in inflation. Remember, this was during the Nixon era where the Fed was pressured to cut rates too early as it was an election year and the president didn't want to induce a recession by keeping rates high for a long period of time. Of course, with the expectations of interest rates peaking at 5.5 along with lower consumer confidence and higher unemployment numbers, the markets rallied strong, ending the week at 4,512. Now, with this rally, if we turn on the moving averages, we were able to reach the 20-day moving averages, which could again act as support in the coming days. Let's draw a Fibonacci chart here. And as you can see, we are at the golden pocket at 61.8 resistance. We could potentially consolidate back into the 447 zone here at the 0.5 fib, which is also a confluence of the 20-day EMA support level. And of course, if we look at the options expirations this Friday, we have a call wall here at 453 and a put wall here at 440, and maximum pain sits at around 445. So we could see some profit taking happening this week as we head into a quiet week. Not much economic data coming in. Let's take a quick look at some fund flows. We see a lot of corporate accounts with heavy buys into the markets for the last 4 weeks. Retail traders, that's us, have seen significant buys compared to the 4-week average, and a pause in institutional buyings where they were heavy buyers in the last 4 weeks. But if we look at hedge funds, they've been net sellers for the last week compared to the 4-week averages. Could they be anticipating a September drawdown? No? We'll see. But for now, that's it for this week. If you found this episode useful, please like this video and subscribe to the channel for more updates. And again, good luck with your trades, manage your risk accordingly, and I'll see you again next week. Bye-bye.